When they report earnings, they're giving you the current price action or the current earnings of that company. The smart money says, what are they going to do in 6 to 12 months? And let's position ourselves there. Because remember, smart money has literally billions of dollars in these stocks or in anything. And so they can't on a dime just say, hey, let's sell our $5 billion of NVIDIA, right? They can't do that. They have to do it ahead of time. They have to start working out of positions. And the markets, I don't care if it's crypto, if it's stocks, what you see is investors position themselves based on 6 to 12 months out. That's just what they do. That's how we work. We always position ourselves for the next move, not the current move.
Unit labor costs, which serve as an indicator of wage inflation, experienced an upward revision to a 2.2% annual rate in the second quarter. This figure was higher than the initial estimate of a 1.6% pace, as reported by the U.S. Labor Department. Additionally, the government revised down the second quarter GDP growth rate from the initial estimate of 2.4% to 2.1%. Despite this, the August unemployment report released last week revealed robust hiring trends with a gradual softening in the labor market. According to Michael Farrelly, the chief U.S. economist at J.P. Morgan Chase, there is no indication that companies are reducing their workforce. Instead, the data suggests an inclination toward higher claims. Surprisingly, claims fell to their lowest level in nearly 7 months. Tom Simons, a money market economist at Jeff Gareth Soloway, explains that while there have been brief periods of elevated claims in 2023, especially in June, these instances have been short-lived and often tied to special factors. In his video analysis, Gareth Soloway delves into these crucial economic metrics, noting that the Federal Reserve desires lower numbers to halt interest rate hikes. However, it appears that the desired numbers are not materializing. Soloway further explores the dollar chart, crypto trends, and other stock market indicators, highlighting both similarities and changes that occur with various economic news releases and how investors can make informed trades based on these insights. Join Gareth as he elaborates on these concepts in the video.
So what we can see here very clearly, guys, take a look at this. We see this news coming out this morning. U.S. unit labor costs higher in the second quarter than initially thought. What does that mean? Let's translate that. Unit labor costs. Costs are inflationary. All right, so right off the bat, that's an inflationary headline. That's inflationary economic news. So that is a very important point here. The reason why that's important, folks, is because, again, the only way the Fed can stop raising and start lowering interest rates, which is what the market craves, is if we see inflation continuing to come down. Lately, we've seen oil go up, and oil again, nearing $90 a barrel. We've seen gasoline. We've seen other costs going up, and that is putting a major cramp in the Federal Reserve's ability to cut these type of things. All right, another thing, check this out. Employment claims. All right, employment claims coming down. And this is a wild one, folks, because even I'm surprised at this. Now, whether this is because of August and it's just a dead month and people are like, hey, I'm going to hang out with the kids until we get into September. Because remember, this is from last week. So again, this is mostly that kind of holiday week going into Labor Day. So it's possible people just said, you know what, I have to file for unemployment, but I'll wait till after the holiday. I'm not going to worry about it now. That is a possibility. But check this out, guys. All right, we saw the number come in for people filing for unemployment at 216,000. The expectation was for 230,000. Okay, so again, a much lower number of people filing for unemployment. That generally speaks to a stronger economy. All right, now again, like I said, maybe it had something to do with the holiday. We'll know next Thursday when those next numbers come out. But again, it was the lowest number since February. And that's something important to keep an eye on because here we're looking for weaker economic news. The market wants weak data. It wants bad data. Bad data right now puts the Fed on the sidelines. It means hiking is over. We're not seeing that. So the November rate hike, which again, the markets are kind of 50-50 on, now after the data today and the unit labor costs could be starting to spike just a little bit in terms of expectations.
The Federal Reserve's current pricing model now indicates a 52% probability of an interest rate hike on November 1st, up from the 40% estimate earlier in the week. This increase follows a surprising surge in the ISM Services survey for August, which revealed an acceleration in various aspects, particularly in terms of prices paid. The index climbed from 52.5 to 54.5, while the pricing measure surged from 56.8 to 58.9. The market is currently wrestling with uncertainties regarding the extent of future Fed rate increases and their duration. While Fed officials have hinted at leaving rates unchanged this month, they remain vigilant, closely monitoring economic data to inform their next steps. While some economic indicators have exhibited signs of moderation, the robust performance of the ISM services sector, which acts as a forward-looking indicator, suggests that there is still considerable strength in the economy. In essence, the market is adjusting its expectations, and the ISM services survey results indicate that there may be more resilience and potential for rate hikes than previously anticipated.
Here we have the US dollar, and it is climbing. This is the Dixie, and this is the daily chart, right? So I put in my trend lines. I want you guys to be all kind of focused on the trend lines here. But here we clearly see that the Dixie continues to move up. It is higher today. If I zoom in, I'll show you here. The dollar, again, on the back of this news, is going higher. So here you are, right? This is today's candle right here, and that, again, is moving up. Now, again, I'm a skeptic. I think that we're closer to the end of the dollar run than the beginning. But again, news like today, you're watching for the price action. And I'm going to tell you this, guys. When you see good economic news and the dollar actually reverses, that's a signal of a top. It's kind of like what we're seeing in Bitcoin right now, where in Bitcoin, we see how good news continues to be a sell-off factor, right? So going to yesterday, this is the 10-minute chart on Bitcoin yesterday, we did see this big pop on an intraday basis when ARK Invest filed for an ETF for Ethereum. But look at this is the 10-minute chart. So literally you had this, it was breaking down, and then Bitcoin surged on the back of that news, and then literally within 20, 30 minutes, it gave up the entire gain. We saw that with Grayscale. Within 2 days, we gave up the news on Grayscale, Ripple within 1 day. And again, this is the type of stuff that tells you as a price figure that price action is still bearish when it can't hold good news gains. On the other side, when we go back to the US dollar, that's something I watch for as well. So in this situation, we are seeing the dollar actually starting to pull back. So again, this is something I pay attention to, right? Think about it. All it is inverse, right? If you're rooting for the dollar to go down, or even if you don't care like me, and you just want to be able to trade it, you have to look for these signals. So what did we just see on the Bitcoin chart? Bitcoin generally has been bearish because every time it gets good news, it pops, right? It pops, and then it reverses that move to the downside, okay? Now here on the dollar, and this is still early in the day, but here we had that news, the good economic news, the dollar popped on the 10-minute chart, and look at what's happening to the dollar right back down. So that's something that I'm going to pay attention to. I'm not going to say it's anything significant yet, but again, as I said, based on my analysis, there's far too many people now bullish on the US dollar, and that concerns me as it usually signals a top. In addition, if you go to the daily chart of the US dollar, look at the run the dollar's had. I mean, in all fairness, if you look at this chart, this is a chart that probably is getting closer to the end of its run than the beginning, and that's what we're going to see. Maybe it gets up here, which is just a little higher, about 50 cents higher on the Dixie, but either way, to me, this is starting to look like an extended chart. All right, next we take a look at the 10-year yield. Now, this is another important one. All right, now, the bond market is known as the most important market out there. It's the biggest market in terms of money. You might think the stock market's bigger, not even close. The bond market is way bigger, and when you hear about smart money, when someone says, hey, where does the smart money play? The smart money plays in the bond market. That's just the facts of it. It's more money, it's bigger institutional money. That's where it is. So what you also want to do is you want to look at the 10-year yield and see what that's doing. And essentially what I'm doing is I'm trying to take you through my mindset of when I get economic news, I see, okay, the media is telling me that expectations were here, we came in here, or we came in here. Now, what do? My first process is to look at the US dollar right now, then the 10-year yield. And what I'm doing is I'm not going by what the mainstream media is telling me, what people are telling me, oh, this was a good number, this was a bad number. No, I go to the actual price action. And the price action will tell us more about it. Because what this can tell you is if yields, and by the way, yields were popping to 4.29%, now they're starting to come back in. If yields start to fall, what does it tell us? It tells us that smart money in the bond market does not believe that the jobless claims numbers that came in stronger or unit labor costs are anything significant, and in fact, they're expecting an economy that's going to weaken, and therefore rates would come in. You see what I'm saying here? How you kind of don't want to just look and say, this is the same thing with earnings, by the way. A good example of this was NVIDIA, right? So NVIDIA, we know that NVIDIA had these great earnings. The stock was up after hours a mile, up to $520. The next day it fell and closed at like $470. It was basically flat on the day.
In a recent note to investors, Morgan Stanley's Mike Wilson delivered a cautionary message for the stock market. Wilson, known for his bearish stance, expressed his belief that economic growth is likely to fall short of expectations, potentially disappointing U.S. equity investors. Despite the impressive year-to-date gains of 18% for the S&P 500 and a remarkable 43% for the Nasdaq, Wilson cautioned that the prevailing optimism, particularly in tech stocks, might not be sustainable. During his appearance on the Thoughts on the Market podcast, Wilson reiterated that historical trends, whether positive or negative, do not guarantee future outcomes. He pointed out that the significant stock market rally this year has been driven by elevated valuations. However, with forward price earnings multiples hitting 20 times on the S&P 500, stocks are now pricing in expectations of higher earnings and growth, raising concerns about the longevity of these valuations. Wilson's previous warning about the market being in a precarious zone, where investors might struggle to navigate lofty stock prices without potential repercussions, prompts investors to reevaluate their positioning for the next phase of the market. For more daily dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.